Hi, this JP Morgan Pro says the Fed has it backward. Rates need to be cut to lower inflation. Critical information for the US trading day. Well, this is a little bit late because the numbers came out and they're hot as hell and inflation's gone up, not down, above expectations. Let's read what Barbara Kohlmeier has to say about this and what she has to say about JP Morgan. According to Barbara, it's been a long, dry run for the S&P 500, the SPX lately. That is looking through the at-the-high lens. As Jim Reed and other strategists at Deutsche Bank point out, the S&P 500 hasn't seen a new all-time high in 7 straight sessions. I don't think that's cause for concern, considering that we are at all-time highs and we haven't dropped down. So it's not exactly bearish, but there is some stagnation in momentum. Back reading. That dearth of highs comes as investors brace for CPI data on Wednesday. As I said, that's already come out and it came out hot. One more strong reading might put the kibosh on hopes for a June rate cut from the Fed, and in the view of some, crushing both stocks and bonds. Well, looking at the charts right now, we've had a 1.5% drop on the Nasdaq and the S&P. The market hasn't opened. This is all taking place in pre-market after the data. I see also that Apple, Nvidia, Tesla, etc., Google, and so on are all down. Then we have a passage saying that the economists expect a decrease in inflation. Well, that didn't happen. And then on to our call of the day from Jack Manley, global market strategist at JP Morgan Asset Management, who says the Fed has this all wrong and is making things all worse, as it data watches for clues on when to move. And then there's a lot of blurb about what's in and what's out of the inflation numbers and how they measure everything. And a bit of chit-chat about shelter and automobiles and gasoline. Gas prices are up again. He then goes on to say, I think we're in this funny, peculiar chicken and egg type situation where you're not going to see meaningful downward pressure on inflation until you see meaningful downward pressure on shelter costs. And you're not going to see meaningful downward pressure on shelter costs until the Fed lowers interest rates. That kind of makes sense. I must add to that the US is also now paying over 6% of its GDP to cover lending. And then there's a lot of blah blah in this article about risk on, risk off, the buzz, CPI predictions, and what actually might happen. Well, we know what happened, as I said, and so on and so forth. So the best we can glean from this article is that someone at JP Morgan thinks that the Fed needs to cut rates to bring inflation down because housing costs are too high and it costs too much to borrow money to buy a house. That may be true. It also costs too much for the US government to borrow the amount that they're borrowing. Add to that, we've got an overcooked market. We've got an election year staring us in the face. We've got debate about whether it's going to be 1, 2, 3 or no interest rate cuts this year in the US and globally. And we've got various central banks meeting around the world to think about their own central bank rates. An interesting time ahead. And if you're like this JP Morgan Pro, you probably don't really know what's going to happen next. Take care.